Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we are going to look at what I've started calling the hidden mechanics of the 2026 market. You know how sometimes you look at your car's dashboard, everything looks fine?
Yeah.
The speedometer says 60, the radio's on, but if you pop the hood, you'd see the engine is like about to explode.
That is a terrifying image, but yeah,
Yeah.
it's a pretty accurate one for the financial world right now. On the surface, things look familiar.
Right?
But underneath, the plumbing,
Yeah.
the way money moves and where value is stored,
Yeah.
that's all shifting in ways most people just aren't seeing.
Exactly. And to get a handle on this, we've gone through some recent extensive data analysis, some new market reports, and filings from the big players.
Yeah.
And we've got three sort of big pillars to get through today. First, we need to talk about the digital dollar, the idea that stablecoins are just cash, but online. We're going to challenge that.
It's really an infrastructure problem disguised as a currency problem.
Then we have to talk about gold. Good old, boring gold. Except, according to the data, it's having a bit of an identity crisis. It's acting less like a safety blanket and more like a volatile AI stock.
That correlation is one of the strangest things on the charts this year, truly.
And finally, the Oracle himself. Warren Buffett, Berkshire Hathaway is selling Amazon, a lot of it, and buying a newspaper.
It sounds kind of absurd when you say it out loud like that, but when you connect the dots, there's a very clear, very defensive theme emerging.
Okay, let's get into it. I want to start with stablecoins. The pitch has always been so simple, right? I give you $1, you give me a digital token worth $1, it's safe. End of story.
Simple.
But this report we have here from the MIT Digital Currency Initiative, it basically says, not so fast.
Right, and this comes from Neha Narula over at the MIT DCI. And she points out that for years, everyone, regulators included, has been obsessed with one question, the collateral.
You have the dollar.
Do you have the dollar? Is it in a bank? Is it in a treasury bond? And look, that's critical. If the money isn't there, it's a fraud.
Sure, that's step one.
But what MIT's finding is that we've completely ignored the rails. They use this plumbing analogy that I think is just perfect.
Okay.
Imagine you have a huge tank of perfectly clean, safe drinking water in your backyard. That's your collateral. The money is there.
So I'm not worried about the water quality.
You're not. But the pipes
Yeah.
that led from that tank to your kitchen tap are rusty, or they clog, or maybe they run through a neighbor's yard who can just turn them off.
So it doesn't matter how much water is in the tank. If the pipe bursts, I'm still thirsty.
Precisely. That's the hidden plumbing risk. The danger isn't that the value disappears, it's that the system to actually settle the transaction fails.
Right.
For a stablecoin to work, especially in a crisis when everyone wants out at once, 3 different systems have to work perfectly. Instantly.
What are they?
1, the treasury market needs to be liquid so the issuer can sell bonds for cash. 2, the brokers need to be able to handle that trade. And 3, the blockchain itself has to be working.
See, that third one, I think we all just assume that's a given. The blockchain is supposed to be the always-on part, you know?
We assume that, but it's not always true. We're talking about 247 settlement. So what happens if a blockchain gets congested? It's like a digital traffic jam. Suddenly the fee to move your money costs more than the money you're trying to move.
So your funds are effectively frozen.
They're frozen. Or what if there's a bug in the smart contract? It's just code. Money can get stuck. It's not stolen, but you can't access it.
And this brings up the case from January 2026, the Tether and Tron network thing. I think people hear crypto and they just assume it's uncensorable.
That is a very dangerous assumption. In January, Tether froze a whole bunch of their stablecoin, USDT, that was on the Tron network. Well, Tether will tell you it's for compliance. They're stopping bad actors, sanctioned groups, and, from a regulatory view, that's their job. But for an average user, it's a wake-up call.
That these rails have an off switch.
They have an off switch. This isn't cash under your mattress. It's cash on a privately owned railroad track. And the operator can flip a switch, and your ownership suddenly becomes very theoretical.
It really changes the definition of possession, doesn't it?
It does. And you look at new laws like the Genius Act. It's all about auditing the reserves, making sure the dollar's in the bank. It barely touches this plumbing issue.
So we're regulating the water tank, but ignoring that the pipes are held together with duct tape.
That's a perfect way to put it.
Speaking of regulation, there's another fight brewing here, the interest debate. This feels like the main event, especially for the big banks.
So this is the heavyweight title fight. There was a White House-led meeting back in February on this, and apparently it got pretty heated. The core question is just, can a stablecoin pay you interest?
Well, let me play devil's advocate. My savings account at Bank of America pays me interest. It's not much, but it's something. Why shouldn't my digital dollar?
That is the exact argument from the crypto companies. It's my money, I should earn a return on it. But you have to see it from the bank's perspective. Their whole business model relies on what they call sticky deposits.
Your money just sitting there?
It's just sitting there, so they can lend it out. Now, imagine a world where your digital dollar pays, say, 4 or 5% yield, and you can move it anywhere in the world 2047 instantly.
Why would I keep my money in a regional bank earning, what, 0.5%?
You wouldn't. And that is the absolute nightmare scenario for them. They call it deposit flight. They are arguing to the White House that if stablecoins can offer yield, it could just destabilize the entire banking system.
So it's a turf war.
It's an existential one, stablecoins versus bank deposits, and the regulators are in the middle trying to figure out the rules of the fight.
Okay, so the digital cash is stuck in leaky pipes, and the banks don't want it to pay you interest. That's great. Let's pivot to what's supposed to be the antidote to all this tech chaos. Gold.
Yes. The barbarous relic.
The ultimate safety blanket. When things get scary, you buy gold. But looking at the charts from earlier this year, it's just been thrashing around. It hit a record high, over $5,000, then started acting like a meme coin.
It really is.
Yeah.
I've been thinking of gold as the designated driver of the investment world.
Okay.
You know, it's the boring friend who drinks water and just makes sure you get home safe when the party gets out of hand. But right now, gold is on the dance floor, taking shots with the high-risk tech stocks.
That's a great image, but why? Why is the designated driver partying? It's supposed to be uncorrelated.
It comes down to who is holding the gold now. The asset didn't change, the owners did. The data shows this massive correlation between gold and the AI tech sector.
So how does that work? How does NVIDIA's stock price move a gold bar?
It's a liquidity cascade. So imagine you're a hedge fund, right? You're loaded up on AI stocks, probably with borrowed money, with leverage.
You're all in.
All in. But you also hold some gold, as a hedge. Then suddenly, tech stocks tank. A bad earnings report, a regulatory scare, whatever. Your broker calls. It's a margin call. They need cash now.
And all your cash is tied up in the losing stock.
Exactly. You can't sell those. You'd lock in a huge loss. So what do you sell? You sell the only thing that's held its value. You sell your gold.
So gold gets punished for doing its job and being stable.
Pretty much, yeah. You get this bizarre effect where tech crashes and gold crashes right along with it because it's being used as a piggy bank to fund the losses from the casino next door.
That makes so much sense. And there's another factor here, right? The market never closes anymore.
Right. The 247 trading.
Yeah.
eToro just enabled this for gold. And that's a much bigger deal than it sounds. Because gold used to have hours. Markets closed. You had the weekend to, breathe and process news. Now it's exposed to the weekend panic that used to be just for crypto.
So a rumor starts on social media on a Saturday night.
And gold can crash before the markets even open on Monday in New York. The always-on anxiety has infected commodities.
And then you throw the ETFs on top of that. We saw $19 billion flow into gold ETFs in January alone.
It's a huge amount. And ETFs act like a megaphone. When money piles in, it shoots the price up. When it rushes out, it amplifies the crash. So, yes, gold is a hard asset. But right now, it's a trading asset.
That's a huge distinction. So if digital dollars have plumbing issues and gold is acting like a tech stock, where do you go for actual safety? Which brings us to Berkshire Hathaway.
The Oracle of Omaha.
We looked at their 13F filings, and it looks like Warren Buffett and his team are doing some serious house cleaning.
House cleaning is putting it mildly. It's more like a full-on renovation.
The big headline for me was Amazon. They sold, 80% of their stake?
Yeah, down to just 2.3 million shares, an 80% cut. That's basically a vote of no confidence in the current valuation. And it's not just Amazon. They trimmed Apple by about 4%, Bank of America by 9%.
Now, to be clear, Apple is still their biggest holding by far, right?
Oh, absolutely. It is still the crown jewel. This isn't a dump. But trimming Apple and dumping almost all of Amazon, the message is clear. They're taking chips off the table. They're looking at these sky-high tech valuations and saying, we'll take the cash. Thank you.
Okay, so they're selling the flashy stuff. What are they buying? Because this is where it gets weird to me. They bought the New York Times. A newspaper.
I know. It feels almost retro, doesn't it? In the age of AI and the metaverse, he buys a newspaper. But if you look at the fundamentals, it's a perfect Berkshire play.
How? I mean, isn't print dead?
Print might be, But the subscription model isn't, and that's the magic word, subscription. It is steady, reliable, recurring cash flow. It's not a growth at any price gamble. It's a people pay us every single month play.
It's defensive.
Extremely defensive. And look at the other buys. Chevron, Chubb Insurance.
Energy and insurance.
The most boring essential things in the world.
You know, it feels like they're winterproofing their house.
Oh, I like that. Go on.
They're selling the flashy summer convertible, that's Amazon, and they're using the cash to buy a sturdy generator and better insulation.
That is a brilliant analogy. That's exactly it. Energy from Chevron heats the house. Insurance from Chubb protects you when a pipe bursts. They're buying things that work when the economic weather gets bad.
And we should remember, it's not just Buffett anymore. There's a management transition happening.
A key point. Greg Abel is CEO now. And this portfolio reflects a very disciplined, valuation-focused approach. They're not chasing the AI hype. They're looking at the price tag and saying, too expensive. It's a pivot to safety and cash flow.
So tying this all together, we have these three very different stories, but they feel connected.
They're deeply connected. What we're seeing is a fundamental redefinition of what risk even is.
Yeah.
Well, first, infrastructure. With stablecoins, we learn safety isn't just about the asset, it's about the plumbing. The risk is technical.
You can't spend what you can't move.
Right.
Yeah.
Second, behavior. With gold, we see safety is relative. The asset should be safe, but it's held by people taking huge risks, so it's behaving dangerously. Its owners are corrupting it.
And Berkshire.
Berkshire is the rational response to all of that.
Yeah.
They're looking at this crazy world and saying, we're going back to basics. They're buying boring, reliable cash flow. Insurance, energy, subscriptions.
It's a move to simplicity.
It's defensive positioning. It's the smartest money in the room saying, we're going to sit this crazy part out and just focus on what works.
That's a perfect place to wrap it up, but I want to leave our listeners with one final thought to chew on.
Let's hear it.
Based on everything we've talked about, if gold is now trading like tech, and the safety of your cash depends on digital pipes, where do you actually put your money to keep it safe in 2026? The old answers, put it in the bank or buy gold, might not be the right answers anymore.
The definitions are changing. And if you aren't updating your own definitions, you might be taking risks you don't even see.
Well, that is all the time we have for today. We hope this deep dive helped you see a little further under the hood of the market. It's complicated, but understanding the plumbing helps.
Stay curious.
Don't forget to subscribe and hit that like button.